Rafael, ¿estamos en línea?
Sí, ya comencé el stream. Falta que la señora Alicia se conecte.
Muy bien, quedamos al tanto entonces.
Sí.
Perfecto. Muy buenos días, les agradecemos a todos los que están ya incorporados a esta...
Good morning. We would beg everyone that is connected for this event on the Economic Survey of Latin America and the Caribbean. We will be starting in a couple of minutes. Thank you, and please stay online.
No me podía conectar.
We are ready. I was having difficulty connecting. I do apologize. Thank you, Executive Secretary. We were just saying that we are now ready to start. First of all, we would like to greet everyone from Santiago de Chile at the Economic Commission for Latin America and the Caribbean. And right now we will be beginning the press conference to launch the new ECLAC report, Economic Survey of Latin America and the Caribbean, through the YouTube, WebEx, and the ECLAC streaming. We would like to greet everyone, and especially the journalists who have registered to be part of this press conference, as well as ECLAC colleagues who are following us and UN colleagues who are following us from different parts during the pandemic. The Executive Secretary of ECLAC, Alicia Bárcena will be delivering the main conclusions of the report, and after the presentation by the Executive Secretary, we will open up to a period of Q&A by journalists And we would like to remind representatives of the media that have registered that as soon as possible, in order to ensure we answer your concerns, that you send us your questions in writing, either using the chat platform that is available through WebEx or by email conferencia prensa at cepal.org. I repeat, conferencia prensa at cepal.org. You can send us your questions by email or using the WebEx chat in order to respond your concerns and questions regarding this launch. Executive Secretary Alicia Bárcena, the floor is yours, and so we will be hearing with great attention the conclusions of this 2020 economic report. Well, thank you and good morning, everyone. I would merely like to ask if you can see the screen. Are you seeing the presentation? Yes, we are. Perfect. Very well. Thank you very much. And so this report that we are presenting today is focused above all on the active macroeconomic policies required for recovery and economic transformation and social transformation. The truth is that this study has three main parts. One, where we analyze the outlooks as a whole, and the other, when we, of course, see which has been the impact of the pandemic on the region. And, of course, we speak in the second part on the fiscal and monetary international conditioning factors that the region will be facing. And since we will later on be seen the region is making significant efforts, countries as well, this will be insufficient. And so then we're focusing our look on what should be done from the viewpoint of international cooperation. And so these are the main messages of this study. And we see that, of course, as we've seen in several ECLAC analysis, this will have an impact on what is social, economic, and production. But what we would like to highlight here is that the consequences and medium-term impact will be greater than expected. They will last longer than was expected, and so therefore will have an impact on growth, unemployment, inequality, and poverty. And these will be more long drawn out than expected. And so resuming the levels of economic activity that we had prior to the crisis will take several years, and that this will be slower than the subprime crisis. And so that is why here we are highlighting the instruments that will be necessary to be able to resume those levels more quickly. And recovery and transformation of the economy will be essential for this to maintain expansive macroeconomic policies. Expansive or quantitative easing measures. These active policies will require of a framework of sustainability, as we know, and this will have to do with how much we can move to the treasury and what sort of international support will be required, common access to financing under appropriate conditions. And I do believe that international cooperation has clearly focused on the global liquidity, because there is global liquidity. The issue is that it is not appropriately distributed. Developed countries have a lot of liquidity, but developing economies do not. And that is what this message is also included in the study. It is clear that this has been the worst crisis of the last 100 years, with major impacts on social aspects, production, and that will endure in the medium term, as has well been said. And we have said this many times. And what we see with concern is that we are facing a lost decade in terms of GDP per capita, and that will be of a fall of 9.1% in GDP growth. But GDP per capita at regional level will be 9.9%. And this will be a GDP per capita similar to the one we had in 2010. We have set a close of 2.7 million formal enterprises closing. And so, how long will they take to recover their production capacity? And unemployment that will affect 44 million people. And the truth is that unemployment is of concern because we're talking of unemployment that, in fact, grew in this stage 18 million people more from 2019 and 2020. And on the other hand, we also have increasing informality, 54%, affecting 159 million people in the region. This is a lot, and we see that only 23% of those who do have a job can do working from home because they do not have an internet connection, or the connection that they do have is poor quality. And poverty will also have a 15-year setback. We're going to reach 231 million people at levels that we had in 2004, and external poverty will go back 30 years. Now, I would like to clarify that these poverty estimates are calculated, not taking into account yet the measures applied by governments. In November, we will be presenting an outlook on what has happened with these measures that have been adopted by governments in order to respond precisely to poverty and extreme poverty and unemployment.
What is quite clear that we cannot avoid is that 53% of employed persons do have medical health coverage, and 46% have another pension system, and the others have nothing. And 66% have a contract, but not the others. That means that we have informality rates of 54%. As the strong drop in aggregate demand has been seen in 2008. That was the subprime crisis. And here we have a much greater drops than what we had during the subprime. We have also strong decrease in consumption and investment, and naturally in the volume of exports. These three variables are indeed those that define aggregate demand. We During the subprime, there were strong drops, yes, but right now we're facing much stronger ones, and that is a difficulty that we have in the recovery. Now, as to the historic drop of GDP, we can look at 9.1%. The economic activity started affecting the region in the end of March. The first quarter of this year already showed a drop in 9 of the 11 economies and a slowdown in 8. In Latin America, then, we saw an economic recession coming in the first quarter with 1.5 decrease and a drop of GDP in minus 9.1. ECLAC forecasts a greater drop in South America, 9.4, 8.4 in Central America, and in Mexico, 7.9 for the Caribbean, without counting Guyana. And this is certainly associated to the historic drop from USA of minus 6.5, Europe minus 8.7, and China is expected to be of 1%, although China had a positive surprise in the second quarter with a growth of 3.2%. These are our figures. We have not changed the negative growth rate of minus 9.1. We'll revise that at year end, but we'll continue for the time being with these rates. Contrary to the subprime, and this is extremely important, we have seen three scenarios. And what we wish to highlight here is a model that is used with an index that reached 100 in 2008, and the subprime showed a drop in 2009, but that was a 2% drop in activity levels that was immediately recovered in 2009. But right now, in the current crisis, even if we were to double the average rate that the region has had in the last 10 years of 1.8 in green, The green line is the average rate for the last decade. And if the region were to grow at 1.8 in 2025, we will just then reach the GDP of last year of 2019. If we were to double that average growth rate to, for example, 3%, which we'll see later on, we would reach 2023 with the rates of 2019. And if we were to grow like the average uh, rate of the last 6 years, it would have been of 0.4. So we would still not reach the growth that we had in 2019. We're talking about a decade. So these scenarios have been done to show that the recovery will be much slower. We must be prepared for a recovery that will not come about next year, not even in 2022 or 23. That means that we must get ready. We must be prepared for a much slower recovery. And in following the lines of the drop of GDP of the first quarter of 2020 in the region, we see that this first quarter had a drop of minus 1.6 and in the second of minus 15.5. And here we see the behavior of that growth rate in Argentina that has been truly much affected, as well as Peru, Mexico, Colombia. Here we see some of the countries that have had an negative interannual rate, a strong negative rate in the second quarter. Let's hope that the third will be better. So what is it that we bring in with this survey? First of all, the importance of having active macroeconomic policies for many years in the future that will be needed in order to grow back for structural transformation, an expansive fiscal policy with sustainability, focusing on public income. Yes, we must try to figure out how to have more revenue because it is true that the countries have implemented several types of fiscal easing and support. And this has been extremely important in order to face the pandemic, low incomes, etc. But we can continue with this. It won't be over now, and we will have to have monetary policies, expansive fiscal policies. In monetary, both conventional and non-conventional, always strengthening capital flows in order to maintain macro financial stability in the short and midterm, especially having to do with capital output, flight. Now, this is extremely important for the region. We must have our voices speaking out loud and clear because we are a mid-income region which sometimes make it difficult to have access to concessional funding. Pandemic has completely changed fiscal policy's direction. Before the pandemic, fiscal policy focused in measures to reduce primary deficit. In 2016, that was of 1.1. In 2019, 0.6, with austere measures of fiscal consolidation. Indeed, that goal was being reached. Primary deficit went down. But the adjustment variable, as usual, has been into capital spending, and that has affected the region. It is going to set limits to our recovery. And the budgets for 2019 that were approved for 2020 continued in that trend. But I do believe that it must be said that the importance of public fiscal policy action has shown the importance of heading towards expansive fiscal policy where it will not be possible to be austere. In this survey, we have brought in detail the fiscal efforts conducted by our countries. we have a disaggregated list of fiscal efforts that reach as an average of 4.1% of GDP, and state guarantees of loans of up to 10% of GDP. There are some countries that require less fiscal efforts than others, such as Uruguay. It requires less efforts because it has historically a health system that has been able to better face the pandemic. Fiscal policy in other countries has had to be greater, and the state guarantees for loans reach 10%. That is the case of Peru, investing 10.7% in state guarantees. We have also seen budgetary reallocation, the placing of sovereign bonds in abroad for $24.5 billion between March and September. Sovereign funds have been used in Chile, Colombia, Mexico, Panama, Trinidad and Tobago, as well as lending multilateral institutions funding. This has afforded about 22.5 billion to many of our countries. 4 of our countries have flexible loans from IMF amounting to $107 billion. But it remains clear that the fiscal policy can become a tool in order to face social and macroeconomic shocks, both in the supply as well as the demand that has been a constant in these crises, very different from the subprime. It has supplied both, it has affected both supply and demand. So during this, well, in this table, you can see historically how fiscal policy has been changing from the 90s. Then there was a relaxation, a softening of spending, and in the 2000, fiscal policy was neutral. Revenue went up. There was the commodity boom that was so important. After the subprime, we saw counter-cyclic policy and a more austere action. And then we saw fiscal consolidation that certainly decreased the deficit. But right now, we're facing something completely different. Fiscal expansion that is reaching 25.4% in total spending, and with an increase of the deficit of minus 8.4%. Evidently, this is of great concern because this deficit is one of the highest deficits seen since 1950. So it is of great concern. How are we to finance this deficit? That is the big question. What to do? If we have to continue spending because we have expansive fiscal policy, we will see that fiscal deficit will go up. So how to finance this? This is what the survey tries to illustrate and to bring us food for thought. Naturally, the big challenge in order to maintain this fiscal policy is that greater indebtedness is to come. Here we have the figures. That will go up 9.5% of GDP as a result of greater primary deficit. And this also occurs in the Caribbean countries. In Latin America, we have an average of 55.3% of GDP in gross public debt for central bank. And in the Caribbean, that will be of 68.8%. Yes, indeed, there's a rise in indebtedness, and that indebtedness, though, is lower than the one shown by even developed countries, according to figures from IMF. The developed countries will be indebted at 130% of GDP. In order to maintain expansive fiscal policy, which is what we're calling here, what is needed, we also must have a sustainability framework focusing revenue, income. We must therefore collect more taxes. We have talked about this often, but now we must emphasize the importance of getting rid of tax evasion and avoidance. We're talking about $325 billion that is evaded. We must strengthen tax collection. That means consolidating income tax to physical, natural entities and corporate taxes. We must also have more tax to property and patrimony, and that tax on digital economy and everything having to do with the public health as well. And we must re-guide and analyze tax expense that reaches 3.7% of GDP as an average. And in the Caribbean, that's in Central America, that's even higher. Tax spending. Why do we say that this is extremely important to increase, for example, income tax? Let us compare what OECD does. They have twice as much income tax than we do. They also have twice as much in social contribution, in payroll as well, in property tax, twice as much, more than double. In goods and services, less. In goods and services, we're talking about tax on VAT. We are more regressive here. We have more value-added tax. So that is why we make this kind of comparison. Many countries want to go be a part of OECD, which is fine, but they must reach these levels in order to have more tax collection. And the active fiscal policy or expensive one must also join the short term with the midterm, which is fundamental. Whatever we do today will have a big impact in the midterm. The short and the mid start on the same day. So guiding our spending into economic and social reactivation is of the utmost importance in order to push forward demand, that is investment. And some of the countries are already announcing investment that will be employment intensive, but also in environmental sustainability, where infrastructure, creating jobs in transport, digital technology, renewables, and in certainly household income, because this is extremely important in order to encourage more consumption and in order to encourage demand. To encourage supply, we must leverage the finding of liquidity to MSMEs with longer terms because it's going to last longer and at lower cost. And the commerce that is so suffering so much, and how to encourage productive development. And that in digital inclusion, we have proposed a basic basket of 1% of GDP and clean technology as well, and certainly encouraging social inclusion. This shows that we have uh, build up the infrastructure that has to do with life, water, health, sanitation, and the care system where women have such an important role.
Now, historically low levels of inflation have helped stimulate the adoption of expensive monetary policies, unconventional ones and conventional ones. But we must say that this historically low inflation has one aspect that is not that positive, because low inflation reflects a very weak domestic aggregate demand, that is a weak consumption and also weak engagement by investors. And so it is true that this is positive from the viewpoint of expansive monetary policies, but it is also a sign that our economy is insufficiently activated. And so this too has affected the economy, especially confinement, which has led to this low level of expenditure and low level of investment. And so we see that, yes, it is true that inflation is the lowest that we have seen in June. We already had figures of 2.1%, the first time that almost 23 economies record an inflation below 3%. And the truth is that this, as I was saying, does have its positive side, but also its negative side. And in fact, it is a dynamic that occurs in South America as well as Central America and Mexico. In the Caribbean, maybe the only country that is outside the trend is Suriname. Now, in terms of conventional policy, since March, the monetary policy rates have experienced significant reductions, and this means that the policy should be maintained and help economic recovery. That is, at lower interest rates. Well, of course, the intention is to have fiscal financial assistance. It is a very important part of innovation. But essentially, low interest rates, what they promote is precisely an incentive for investment. And these active rates came down in 13 countries, and this has been relevant both in those with different policy instruments, such as these two graphs that we see here. Now, the great majority of central banks have experienced great pragmatism. And here in the report, in the detail, you can't see it here, but you could see it when you take a look at the report as such. Most central banks have implemented unconventional measures, and one very relevant one is the co-financing of public sector credit programs. 27 countries of the region have adopted these measures for the co-financing of public sector credit programs. 11 countries have used direct financing of the public sector, and it is the purchase of public and private securities. And this is very relevant because these are unconventional measures, changes to macroprudential regulations, and all of this with very significant interventions in the FX markets and legal reserves for deposits and mechanisms for trade with banks from outside the region and activation of credit lines. And all of this has helped to support enterprises, debtors, and the public sector as such. Now, also, the rise in systemic risk, which we also see in this report, we see it as a risk that must be observed to avoid this from undermining or putting financial stability at risk and making the recovery more difficult. So what do we look at? Well, we take a look at the various capital groups. So we see there's so much volatility. There's a lot of volatility, especially in direct investment, portfolio investments, and other investments. But we see that the departure of financial groups is more volatile than the arrival of these groups. And here we see the variation coefficient in direct investment increase from 0.9 to 1, and portfolio investment from 1.5 to 1.6. And so this, in fact, has meant that our governments must adopt unheard of measures for macroprudential regulation, as we're going to see on the next screen here, since 2003, precisely because there is more outflow than inflow. And so macro regulation has been more associated to the outflow of capitals than the inflow. And so what we're seeing here is a number of measures that have been adopted by different countries. And this macroprudential regulation aims at reducing risk, increasing the resilience of the financial sector, and limiting contagion effects, and precisely creating incentives for everyone taking part in the market. And so what we need to avoid is underestimating the outflows. That is, the risk stemming from capital outflows. And I believe that this has been relatively successful in the region because, in fact, we've not seen major clashes or shocks in the balance of payments, nor have we seen major macroeconomic risks in the region so far. Now, one very important aspect to increase liquidity, because as we were saying, the international financial institutions recently, and thanks to pressure, I would say, from the UN, by the UN as such, has focused far more on increasing liquidity or redistributing liquidity rather than debt as such. And so issuing special drawing rights and a better distribution of liquidity is what could help create financing in for the countries in our region above all. And so in the report here, where we say that if there were an issue of special drawing rights of worth $1 million, how much of this could reach the Caribbean, for example, 3.480, South America 51.8, the Central American Isthmus 5.1, Mexico, so that the region as a whole 79 billion in special drawing rights. So this is very, very important to expand precisely the financing capacity. If it were a half, 500, and so, well, here's the table, but we believe that aside from issuing more special drawing rights, we need to think about the reallocation of these special drawing rights, the existing ones, because this is also a possible and necessary instrument. Now, another theme for supporting fiscal and monetary policies and better distribute global liquidity, please, this is key, the better distribution of global liquidity through international cooperation, of course. This is institutionalized cooperation among central banks, capitalizing multilateral credit institutions, and of course, in the case of the capitalization of credit institution, ECLAC is also saying that in addition to increasing their financing capacity, that there be certain rules so that the investments be sustainable and that might create jobs. So enhance the use of capital flow regulations, especially outflows, and also expanding a network for financial security worldwide and regionally in order to counteract the negative impact of the volatility of these financial groups, precisely at this time when the crisis is systemic. Now, the region has proposed one very relevant initiative, especially Costa Rica. This is an initiative known as FACE, which is a fund to alleviate COVID-19 economics, the economic impact of COVID. And this is being done by Costa Rica. It is a very innovative mechanism to provide concessional financing for developing countries, regardless of whether they are middle income or not, regardless of their GDP per capita, with a very long repayment period, practically 50 years, and interest rates close to zero. The aim is, well, it's not a free of charge fund, but it is a concessional fund. It's not a grant, but the aim is that developed countries should put up $516 billion in resources or that this money be channeled through multilateral banks for recovery at very low interest rates and long repayment terms. Now, relief and restructuring of debt. For us, this is a key issue. So far, the discussion has focused on relief of debt payments called DSSI, which is a G20 initiative, but that only encompasses the low-income countries. And we believe that this should be extended in time beyond 2020 and 2021 on account of the reasons that we've already mentioned, that this is going to last. And second, extend the coverage to middle-income countries with vulnerabilities and a high burden in terms of interest payments. We've analyzed this, and we see it in this report that the middle-income countries around the world concentrate 96% of the foreign debt of developing economies, with the exception of China and India. But everyone else has 96%. And so a crisis of insolvency of middle-income countries would lead to a world systemic crisis. And so we believe that it is essential that this initiative to sustain the debt service to be extended to the vulnerable middle income countries. This is the case of the Caribbean and Central America. The Caribbean on account of the very high level of debt, and Central America on account of the very high cost in terms of interest payments, and creating an international mechanism for the restructuring of sovereign debt. We believe that more than doing this case by case, it is very important to have a mechanism that is international and that will help restructuring sovereign debt, and with the uncertainties and risks of these renegotiation processes that when they're done individually are difficult. And then relieving the state of debt is an issue that for us is very relevant, especially in cases when the payment of interest is where I believe that we should focus our attention. In interest payments, if you take a look at the graph on the right, it's 2.6% of GDP in comparison to the 2.3 in health expenditure, in comparison to capital expenditure that have come down almost 1 percentage point. And of course, we do have a very relevant social expenditure, but what we want is that this interest payment cost should be postponed. That relief would help countries such as we have in the region. For example, Jamaica. Jamaica has interest payments of 6.1% of GDP. Trinidad and Tobago, 3% of the GDP. And so, Caribbean countries especially, this is very, very high, but also this is extremely high in Central American countries, where it also exceeds 2.6% of GDP. And so, this is a great limitation because countries, especially that do have social coverage, could react quicker and effectively, but others are unable to do so, as is the case in Central America. So we have 4 concrete recommendations for the case of the Caribbean, and that we've put up, we've highlighted at all international conferences that we've been able to take part in. And what we want to propose here are 4 very concrete things. First of all, a special dispensation for the Caribbean. That is, the Caribbean has a very high level of debt and is highly vulnerable to climate change. And so they need access to concessional financing and relief or debt cancellation without any conditions, as we're going to see later on. They need to take part of this initiative for the debt service suspension and attracting private creditors, because the DSSI could scare off the private creditors and the involvement of the regional banking.
Involving bilateral creditors, including the Paris Club, Antigua and Barbuda, and Dominica, would profit from that, especially the establishment of a resilience fund for the Caribbean. As we know, we are proposing a relief of $6.9 billion, that is 12.2% of total debt, in order to create this regional resilience fund, and actually managed by the very same countries, and with the presentation of the Green Climate Fund. And that is something that the Caribbean and Central American countries should have access to. I'm talking about the Green Fund and some kind of subsidies. And let me say that what we wish to highlight in this report is that the recovery and the growth dynamic is facing many, many challenges. There's great uncertainty in terms of the international economy. The pandemic shows big chances of outbreaks. There are many negative effects that will affect the productive dynamisms, employment, and aggregate demand. We do believe that it's important that political desire is important to maintain fiscal policies and expansion monetary policies. We call on uh, financial institutional into um, help out with the cross-border flows. We know that there's greater volatility, and these cross-border flows are risk uh, are are avid for risk. But we're talking about other kinds of risks, and also multilateral dynamics and international cooperation that is not that clear. It's important to emphasize this. And I'd say that would be it, dear colleagues. And I am certainly willing to answer any questions you may have. And before I forget, this is a joint work that has been led by a group of individuals headed by Daniel Titelman, but it's a big group of persons. I'd like to mention them all, but I would especially like to mention Cecilia, Ramon, Noel, amongst many, many others. Michael. In short, there's a group of persons and also from the editorial section. Thank you all. Thank you, Executive Secretary. This then was the Economic Survey 2020 Active Macroeconomic Policy for Socioeconomic Recovery and the highlights. We will now continue with questions and answers. I'd like to repeat the invitation for those of you who are following us to please send your questions to the email conferenciaprensa at cepal.org. And what I suggest is that you pass on these questions as soon as possible. We have already received many questions and we'd like to be able to answer them all. But naturally, time will not allow for that. So please send your questions as soon as possible. Now, let us go into the first three questions. The first one comes from Paraguay. Eduardo Villalga from Última Hora asks the following question. ECLAC, how do you see the Paraguayan performance and what do you think about our GDP for the year? What growth perspectives do you have for 2021 for Paraguay? And he also says, as in Paraguay we have fiscal deficit, and in 2020 the country will have already had 2 years of 1.5% deficit, and that may be repeated by next year. So this is a question. And the next one is Alba from Uruguay. Our colleague Clara Cepeda from El Financiero, Mexico, asks the following. How long does ECLAC believe Mexico will take to go back to growth again with the available income drop in our households, little businesses that have gone broke, and in view of the stimuli that's been offered by the government? We understand the economic encouragement should be received by our main partners. That would be USA. That would have been a good proposal for Mexico. So that was from Mexico. And in this first set of questions, I would like to bring also the question from Marta Trejo Atarayar from Spain. She asks about Colombia's development. At the end of last year, at the beginning of this year, the US president said that he was to take out Colombia from the developing countries list. Does that mean losing aid towards development? Does ECLAC believe that they meet the standards, even though much of the population has no potable water and other kinds of facilities? So we have then three questions from Paraguay, Mexico, and Spain. We now give the floor to Ms. Alicia Bárcena. Thank you. Thank you much for the questions. I now go into the first question, Eduardo Villalba, and the Paraguayan economy. Until the closure of the first semester of 2020, GDP in Paraguay had gone down to 0.9 comparing to the previous year. 4.4% was the decrease of the service sector. This is very important to mention. And naturally, I'd like to say that here we have one of the reasons that was offset in part by the agricultural sector that grew 18.8%. For this year, ECLAC foresaw a shrinkage of 2.2%. So there we believe that the performance of the primary sector will offset in part the measures that have been devoted to the health crisis. On the side of the demand, the decrease in investment and consumption may be partially offset by an increase in government consumption. We still don't have a forecast for 21, but we can say, as with the survey, that in fact, we do believe that this crisis will last more than was expected, even though we may have, and also we may have new outbreaks. Now, what will happen with Paraguay with the fiscal deficit that at the end of this year is amounting 2 years at 1.5 above GDP. At the end of 19, the public debt reached $8.5 billion, responsible for 23% of GDP. That is an increase of $800 million comparing to 2018. And considering the indebtedness of 1.6 billion needed to finance the crisis and the sovereign bond at 450 million, we believe that the balance of the public debt will be at 32%. That is to see, from 23 to 32% by the end of 21. The balance is still low considering the income level of the country, but the share of debt in foreign currencies of 79%. The reserves are of 19%, which involve a relatively low risk comparing to the fluctuation of interest rates. But in Paraguay, growth of GDP suffers from climate and external oscillation. This makes us believe that it is possible or probable that that deficit will be kept and may even rise. Let us go to Claudia Cepeda's question from Mexico. How long does ECLAC believe it will take Mexico to go back to development and growth? And how much would that depend on what will happen with our main partner? Mexico has an economic and health crisis after a drop in growth last year. The drop of growth in 2019 in Mexico was of minus 0.3. Undoubtedly, that is growth lower than previously. Even though there was a certain improvement, we expect that the recovery will be slow, and it will certainly take at least 3 years to go back to the activity of last year. And Mexico is not the only one in the region going through this. It will depend, though, on what is to happen in the last quarter and next year. Economic activity may recover gradually. So by next quarter, we may see certain recovery. But even though, in spite of that, we believe that reaching previous levels would be very difficult. Mexico has implemented a decided policy of transfer to 21 million citizens. More than 10 million women received that, which is an important push to growth. And the Mexican economy, contrary to other countries, does not have some automatic insurance. So it would be important to make headway in more policies for social protection, in unemployment insurance, and these kinds of stabilizers. It would also be wise to go into more formal SMEs. Now, what about pushing the years of Mexico? Well, Mexico and U.S. have a strong, important historic relationship. That's the only country that has a strong increase in exports. Mexico, and I think that uh, that's going to continue. And the U.S. economy is also not going to recover as fast as expected. And even though the U.S. economy may help, we must also support the productive sector, especially SMEs. That is why we believe that indeed that relationship with USA certainly can be very important, very positive. We do believe that it's interesting to see how to leverage more integration within the Mexican territories, especially between at the center countries are those that have shown more dynamism. We must push that up to the north and south. Investment has been announced by Mexico yesterday. The government informed of strong measures that aims at more infrastructure and more job creation. These are topics of great importance. I think that the announcement of an investment plan equivalent to 1.2 points of GDP, where 51 million would go into airport, Felicia Angeles, uh, to the airport corridor in Monterrey. And there are many, many energy projects which may come up into the creation of 200,000 jobs, new jobs. So I think that yes, there is a desire on the part of the government to put in more investment and to leverage supply chains between Mexico and USA. There are some sectors that are concrete where exports have gone up, such as chemical products and other strong sectors that have maintained their exports: sugar, copper, meat, and others. There is more and more integration. Export figures in the automobile sector has also recovered. Indeed, I do believe that for Mexico, the FTA is indeed of the utmost importance. And now I go into Marta Trexto's question from Spain, and the question has to do with Colombia. I think
I think it is important, the announcement made by Trump to get Colombia out of the list of developing countries. One thing is taking it out, and the other thing is that that actually happened. But it does have implications because, of course, precisely what we are discussing is that the GDP per capita is not a good indicator of the level of development. And so, these graduations of taking one country out of the category, moving it into another, is not really an appropriate criteria. It imitates the ability of countries to access concessional loans that help development. And so we are a party to have a structural gap approach, measuring precisely which are the gaps that the country needs to close. Because, say, in terms of education, health, the fiscal situation, informality, in the case of Colombia at least, is very, very relevant. In the last 15 years, Colombia has made remarkable progress in coverage of programs to reduce poverty, and also programs such as Families in Action, giving them greater job and production opportunities. And the truth is that the rate of members in the health system has risen to 95%, and very important outcomes in education, energy, coverage, and so on. But the truth is that Colombia, despite having been rated as a middle income country, does need cooperation resources, especially those linked to peace building. And the international community has understood this. It is important, and that is why it's given Colombia very important support for the peace building process to precisely close gaps, especially between regions in Colombia, rural, urban regions, which I believe is one of the most significant gaps in Colombia. Well, thank you very much, Mrs. Bárcena. And now we will move on to the next questions that have come in. Some of these you have already addressed. But nevertheless, we would like to express the concerns that were sent in by our journalist friends. Silvia Rodriguez from Millennium and Ivan Martinez, Ángeles Aguilar, both from La Razón in Mexico, have sent in their concerns. As I say, it's quite likely that part of these have already been addressed in your very clear response to Clara Cepeda del Faniciero, but I'm going to read them anyway. Silva Rodriguez from the Millennium says, how severe is the damage in Mexico after the COVID-19 crisis in comparison to other countries of the region? How long will it take us to return to pre-crisis levels? And is it possible to return to 4% growth at some point? And what should we do to achieve that? Ivan Martinez, as I was saying, from La Razón, speaking of something that you've just pointed out, what is your opinion regarding the infrastructure investment plan announced by the federal government and the private sector in order to reactivate the economy, and they consider 39 projects with an accumulated investment of 297 billion pesos? Will this contribute to the recovery of the Mexican economy? And also this asks whether ECLAC has changed the forecast of GDP of Mexico for this year. And also from La Razón, there's another question. Part of this I have said you've already addressed. And the question is, how long will it take to recover the economic level for Mexico that we had in 2019? And which would be the repercussions of informality in the case of Mexico? And is there any estimate of progress of debt in the case of Mexico for coming years? Well, these are the three concerns expressed by Silvia Rodriguez from Millennium and Ivonne Martinez Ángeles Aguilar from La Razón in Mexico. And I insist that this has partly been answered, but nevertheless I hand over to the Executive Secretary. Well, thank you. Of course, I will answer Silvia Rodriguez's question, and of course, always thanking you for your interest. How severe is the damage in Mexico after the COVID crisis, and how long will recovery take? And is it feasible to have this 4% growth estimate? Well, according to our estimates, as we've already said, the health crisis and the impact on the economy, including tourism, together with a fall in international prices of the Mexican oil mix and the drop in activity in the US and the rest of the world, is going to lead to a drop in GDP in Mexico of 9%. That is the ECLAC estimate. We have not changed it. We continue with this 9% estimate. At ECLAC, we're expecting recovery, of course, in 2021, hopefully of around 3.2%, but nevertheless, it's still soon to share a figure. We believe that there could be recovery on account of the reasons mentioned earlier of 3.2, but we are assessing this and we will be estimating it more carefully in coming months. And, of course, this to have a gradual economy as of the third and fourth quarter 2020, but well, it is not a total recovery would not be achieved until the year 2025, as we clearly said in our report. And indices of economic recovery. Yes, in 2020, in comparison to the previous month, we saw the inclusion of 608,000 people to the economically active population, going from 52.6 million to 53.2 million. And of the 12 million people who became unemployed, 7.8 have already recovered a job in August. And so the unemployment rate is of 5.2 in August and slightly less in July. However, the loss of jobs did not stop, and the construction sector continues to have a deficit of 100,000 jobs, and tourism, which accumulated a deficit of 327,000 jobs. Now, remittances arriving to Mexico grew 9.4% in the first 8 months of the year, reaching a historical high of $26 billion. This is very important because many thought that the remittances would drop, but they've increased. And tax revenues from January to August were practically the same as in 2019. And so, well, that, of course, there was a reduction in the oil revenues of 38%. But this is what shows that there's not been a reduction in tax revenues as we've seen in other countries. Means this shows that the tax administration system has strengthened a far more effective control, and I would say a reduction or of fiscal privileges, which has given the government a greater margin for action. In August 2020, there was also a rise in the motor industry of 5.8% of units sold. And so we believe that in the 4 consecutive months, there's been an upward trend in the activity, and motor activity, and of a trade surplus. This is very important because Mexico continues to have a very important trade surplus of $6.16 billion in comparison to the one in 2019 of 402 million in comparison to 6 billion. So in the first 8 months of the year, the balance of trade showed a surplus of $14 billion. So exports fell far less than in the rest of the region, and imports also came down less than in the rest of the region. So yes, definitively this is relevant. Now, it is feasible to achieve the 4% that at some point was mentioned. Well, when that was announced, the truth is that there was no pandemic, and the truth is that despite all the efforts made, Mexico still needs to move ahead on the technology and increase productivity and closing inequality gaps. And above all, how to achieve the formalization of this tremendous reserve of informal labor of the economically inactive population, which in the long run would be a great asset for the country. Investment allows absorbing job surpluses and reducing technology gaps, and so we do believe that the investment plan, and here I will go to Yvonne Martinez's question from La Razón in Mexico, where we do believe that this announcement of 297 billion, representing 1.2% of GDP, and that includes Felipe Angeles, the railway corridor, the Monterrey port, and others, and that altogether will create 200,000 new jobs. This undoubtedly will be a major driver for the economy, because there had been a major stagnation of the economy and in the rate of women's engagement. And so it's very important to put emphasis on achieving equal access and engagement for women. And we believe that that is something to take a look at in the creation of these 200,000 jobs. We need to take a closer look at the women's engagement. And undoubtedly, it's very important to maintain the recovery of the minimum wage, which has been a major hit of the policy of President Manuel López Obrador. As we were saying, we continue with our forecasting a 9% drop. The outlook ahead, as we've said, is that could be relevant if this injection in public investment is essential, and undoubtedly also the trade issue will be a major driver for the Mexican economy. Ángeles Aguilar, how long will this take? Well, once again, repercussions on informality. Well, we've already talked about recovery, but the issue of informality is a structural problem in the issue. In the region, 54% informality, around 129 or something million people who are working informally. And this situation is being aggravated with the crisis. And so we believe it is very, very important for companies to help formalize jobs. We have been very much in touch with Walmart, which is one of the companies that has made a very special effort, especially in Mexico and the rest of the region, to formalize employment and including women. We have been very much in touch with the officials because we believe that the large companies, by supporting micro and small enterprises, but who are their special providers, or supporting companies that could help small and medium-sized enterprises and other companies directly. How much could the debt move ahead in coming years? Well, in the case of Mexico, the Finance Secretariat has said that the 2020 debt will be of 53.6% of their GDP, and this represents a rise in comparison to 2019 of 8.1 percentage points. But it does not mean that the country necessarily is getting into debt, but of course it is issuing sovereign debt, which is very novel, a bond linked to SDGs. So that would be, Guido, my answer to the three questions just asked. Well, thank you very much, Executive Secretary. And so now we will move on to the next block of questions. The first of these from Montserrat Toledo of the Chilean Diario Financiero.
There are two concerns here. First, what is the impact of the inclusive point in the macroeconomic, and what about the reactivation? And the third, when will Chile reach growth before pandemic and the social outbreak last year? That is Montserrat from the Diario Financiero. Gabriela Granado from NHK, the Japanese TV with headquarters in Mexico. She has the following question, Miss. The uncertainty on the herd immunity, the something that is not prevalent here. The discarding the passport or the permission according to serological tests. Now, if everything were to reach, there's also an issue with the access. What are the five scenarios that ECLAC can talk about? And finally, in this block, I will read a question from Josefina Bruni from Latin Finance. How do you assess the corporate foreign debt in Latin America? What would be the scope and limitation in the capital markets to attend to financing needs in Latin America during the economic building back? And the last question for this last block comes from Montserrat Toledo. Gabriela Granados from NH Capital, it's a Japanese station, and Josefina Bruni from Latin Finance. These are the questions, and now I hand over to you, Ms. Bárcena. Thank you. Montserrat Toledo's question on how do we see the impact here in Chile? The constitutional process in Chile is here to stay. With a plebiscite that is going to be held October 25th. I think that the flow of this should not have a strong impact in the economy with a calm political environment. That is proof of the government's political maturity and of the people themselves in order to be able to go into this kind of democratic decision. It's an important decision to change the path, which is what ECLAC has been proposing. That is, that we revise the constitution that was agreed on in the 80s, but that has gone through many, many changes during these 40 years. So this process is worth it. It's one of the most interesting processes that have been uh, happening in the region, and that should end up in a new constitution or in a constitutional change in as much as it is concluded. And it should not cause any kind of macroeconomic uncertainty. Chile is well known by the institutional stability, and that is what should prevail. Transparency is certainly going to clear out any doubts, and it's going to be positive to reactivation in as much as uncertainty goes down. The macroeconomic outlook and the reactivation of our economy, as well as in the rest of Latin America, will depend on what happens with the pandemic, on the confinement or lockdown that is needed. Here we have a big, long civic transition, respecting elections. And this, I think, should prevail. Now, how will the country recover in the next few years? Well, as we've said, we believe that the recovery will be slow. It will take a couple of years to go back to the levels before the pandemic. Uh, for the last 6 years, the rate was of 2%. And 2019, I think, can be recovered by 2025, unfortunately. In the last decade, Chile's growth was of 3.3%. In that case, then the recovery would be much faster. Well, not that faster, but at least sooner by 2023. Gabriela Granado from NHK, Japan, the uncertainty on the herd immunity, the wearing of the credibility on the passport, all of the scenario that is being considered towards pandemic evolution, as well as the uncertainty vis-a-vis vaccination. Well, Mexico is one of the countries that have shown a great activity in terms of the vaccine. And all of the members of COMEC have been led by many countries in the region, such as Costa Rica, Mexico, Argentina, Brazil. There are many countries that are very active in Chile as well. We do know that this pandemic can be long, can take long, because we may have secondary outbreaks, as has been seen in developed countries. But we have seen gradual deconfinement processes without ending up in serious outbreaks. Here in Chile, for example, this has been clear, as well as elsewhere in the region. We'll have to see what's happening because this is also related to the winter season. In South America, we're about to come into summer, which can be helpful. We do know that the virus does not like high temperatures, and cold also is related to influenza. We'll see what happens there. The important thing is that countries, governments, and health systems have been learning a great deal in managing the pandemic, and they have been able to prevent the collapse of health systems. A lot of territorial management has been seen as very effective, and we're learning on the go. The third question, can you please repeat the third question, Guido, because I was unable to jot it down? Certainly. I suggest that we uh, tackle this one later on so as to have more precise figures. But that was Josefina Brune who asked about the foreign corporate debt in Latin America and its effect on the capital markets to be able to serve the financing needs in view of our economic slowdown. Daniel Titeman, if you're connected, you can better respond. Certainly. Let us go into the Economic Development Division from ECLAC and the team that was actually in charge of drafting this survey. So I would request someone from the technical department to answer this question. Rafael, can you confirm if Mr. Titelman is online? I don't see him. Well, I can answer then. It's okay, Guido. Please go ahead. As elsewhere, corporate debt in the region has gone up significantly because of the pandemic. There's a strong drop in the real economy and great uncertainty the in the new upcoming growth. Corporate debt during low growth times becomes a big flag because this increases the risks among financial markets. In many countries, fortunately, they have had access to bonds market issuing about $24 million at historic favorable rates and with long terms. Thus, the region is taking advantage of more liquidity in the private markets and more risk appetite from investors. But I would say that during times when the real economy is shrinking at a low point, the dynamic of increasing corporate debt is involves high risks. Thank you, Executive Secretary. And we will now go into the last block of questions. I'm afraid we don't have that much time. So this will be the last block. Eliana Loe from Portadas magazine, Peru. In Peru, the government has helped out the population through issuing bonds, and some of the population has had access to their own pension funds. Will that affect the economic situation, having in mind that Peru has an economy whereby most jobs are informal? Panama. Alma Solis from SNP Noticias. What for the country means uh, that the recovery will be slower than expected? What will that mean for our country? And Patricia Valli from Perfil, Argentina, asks, when should we define the expansion of DEG? And how long would we have to maintain the assistance plans in the regions because of the pandemic? Is there a risk of investment leaving the country and the region because of the economic situation? With these questions from Peru, Panama, and from Argentina, we hand over to you, Ms. Bárcena. Thank you. For Peru, I would say that, as you well said, it's been one of the countries that has been contributing guarantees in more than 10%. As a matter of fact, 10.7% in guarantees. That has been very important and has allowed the drawing of funds from their AFPs. The economy ministry is talking about 12% of GDP, and this has to do with mitigating the impact of 200 basic points that was conducted by the central bank and other measures in order to increase the liquidity in markets and to support the maneuver efforts from the companies.
Great support for enterprises. Authorizing pension fund withdrawals undoubtedly do help reactivate the economy in the short term because they drive consumption. And this has been the case in Peru as well as Chile. But the measures, more structural measures taken, are the ones that will help recovery, both in Peru as well as the rest of the region. These measures have different impact. In some cases, they avoid a greater deterioration of aggregate demand, consumption in the short term, and also mass bankruptcies, which is another very serious issue in the region, and the constant deterioration of employment. And so there are undoubtedly factors that do limit the efficacy. One of these, in the case of Peru, that is very important, informality. It reaches almost 70%. These structural weaknesses in the public health system and this very high level of informality, and that is why sometimes the measures do not have the desired repercussions, because these cash transfers to vulnerable homes are not as fast as possible, and the government has been able to reach these informal enterprises. But well, this is an issue, and implementation faces many difficulties. But the government of Peru, the truth is that this has been one of the most active countries in terms of measures taken to support or in the emergency of this pandemic. The other question by Alma Solis on Noticias Panama: what does it mean that Panama has a slower recovery than was originally expected? Well, according to our forecast, the contraction in Panama will be of minus 6.5% in 2020, and the drop of the Panamanian economy is comparable to the growth that it experienced of 3% in 2019 and 3.7% in 2018. So the drop there is major. And, well, the consequence, of course, has been, without a doubt, the pandemic, confinement, and most affected in the second and third quarter of this year. We're expecting that in the fourth quarter there be a slight recovery, and that in fact the indicator of economic development could perform better. Now, what are the sectors most affected this year and which least? Well, in 2020, those most affected were construction, manufacturing, that already were in a negative dynamic in 2019. There's going to be a major affectation of sectors such as tourism, as we already know. This is a very severe issue throughout the region. And these are activities that have to do with exporting capacity, and that those most affected are construction, hotels, restaurants, the manufacturing industry, trade in general, commerce in general. And the least affected is agriculture. In fact, throughout the region, this has been the sector least affected, and also the consumption of medical inputs and essential goods. And of course, mining, that has also grown, in fact, in Panama and the rest of the region. Regarding transport, storage, and communications activities, which is a central activity for Panama, the canal and air transport, well, it's uncertain. There was a closure in 2019, growth of 6.8, but in 2020 there was also positive growth, but we do not know what could happen. The canal transit in July showed an 8% drop and a reduction of 0.1 in toll payments. This is on account of the contraction of trade in general, worldwide and the region, because it fell by minus 23% exports from the region, somewhat less the imports, but also the drop was significant. Patricia Dali from the El Perfil in Argentina. The extension of special drawing rights, this is a very, very important issue, and there are two steps involved. First, the reallocation of special drawing rights that must be around $300 billion. This reallocation could be done immediately because this is in the hand of the surplus countries, and this could be a very, very important measure. It is voluntary, of course, but it would be essential. And then the last time that this happened, and also the issue of special drawing rights is essential. And that would mean doing something similar to what was done in April 2009, when the G20 was ready to issue special drawing rights. In the document, we considered two scenarios. If there were an issue of special drawing rights of $500 billion, or if $1 billion, what would happen in the region? And we saw that it would be very, very positive in the sense that it would be a factor that would give liquidity to our countries and also financial stability. So we believe that it is essential. Now, the special drawing rights, the issue depends on the board of the IMF and also of what is decided by the US, which is one of the most relevant countries in this decision regarding the issue of special drawing rights. So that would be it, my dear Guido. Well, thank you very much, Executive Secretary, and I've anticipated that that is the last block, but I would like to abuse of your goodwill because there are two colleagues from Mexico who have accompanied the conference and have attentively followed all your answers and would like to ask a couple of questions more. So I ask if you are prepared to answer two additional questions, Executive Secretary. Yes, of course. Very well. In that case, thanking you for your time and disposition, I would like to say that these are colleagues that are usually with us. Irene Saldaña from Universal in Mexico and Adora Villanueva from La Jornada, also Mexico. Yvette Saldaña asks, for your opinion regarding the ongoing discussion in Mexico on limitation to the restriction of science and technology, natural disasters, and human rights trust. How manageable do you believe are the debt levels in the country? And three, do you think it's viable to consider a new loan from the IMF for Mexico? These are the questions by Yvette Saldaña from Universal in Mexico. And then now the last question of this press conference. Dora Villanueva from La Jornada asks, in this report you highlight that austerity it is necessary to expand debt resources. Which would be most counterproductive for Mexico, acquiring for more debt or maintain the current policy of expanding income by merely combating tax evasion? Well, questions that in a certain sense do converge as to the macro policy that should be adopted by Mexico or propped up by Mexico. So these are the questions asked by Universal Doña Villanueva. Well, thank you. And as usual, I thank Yvette Saldaña, who's always with us, and I thank you very much for this. I would like to say that the information that we have, of course, all of this is very recent, but what we know is that President López Obrador offered to make transparent the 200 trust funds during his campaign, and what he's clarified today is that the trust funds will not disappear. What is going to be assessed, as far as I understand, is the performance of each trust fund. And so what is being done is reviewing them, assessing them, and including them to the financial management of each trust fund, but not the aim or the authorities responsible in each sector. But so what he's offering to do is to make the administration more transparent. And in fact, at the moment, the initiative is going through the lower chamber to do away with 109 trust funds, and that would leave a total of $68.5 billion, about 0.3% of GDP, available, and that would be assigned to respond to the COVID-19 crisis. Now, the finance secretary indicated a week back that the beneficiaries, Arturo Herrera I'm referring to, that the beneficiaries of these programs from these trust funds will continue to receive the resources committed to in the budget. So the existing resources to face the economic and health contingency will still be available without resorting to further debt. And so I believe that that is a country policy reviewing the 200 odd trust funds. In this case, the idea is to do away with 109 and releasing those resources, but yes, assigning them to the same goals for which they were originally considered, but maybe under a different format. Just how manageable is a debt level? Well, I believe that in the case of Mexico, the Finance Secretariat, as I said earlier, announced and forecast that the public sector net debt will be of 56.6% of GDP in comparison to 45.5 in 2019. So this will be a rise of 8.1 percentage points of the GDP. Now, the Finance Secretariat is forecasting that the debt level will stabilize and drop as far as 50.3% of GDP. And so they're announcing debt levels management as have been announced, specifically low ones, and efforts made to strengthen public revenues by combating tax evasion and avoidance, which is essential, I believe, for the country to maintain this debt pathway. So it's expected that in 2019, the net debt level, the public sector was 45.5, in 2020 53.6, and it's expected that by 2026 it'd be of 50.3. Just how viable is this considering a country loan from the IMF? Well, we must already consider that Mexico has a flexible line of credit from the IMF of $61 billion, which is a credit line that was approved in 2019 in the month of November and is valid for 2 years. And this is a flexible line of credit that has been valid since 2009. And that meant that Mexico was one of the first countries to access this sort of instruments of the IMF. Dora Villanueva, in this report, we highlight that this is not a moment for austerity. No, it is not. And under this premise, what's most advisable? Well, in fact, what would be most counterproductive for Mexico, whether to acquire further debt or maintain or continue the current policy to increase revenues, well, I would say that since in Mexico the decision is so sound in terms of combating fiscal evasion, and this will lead to important resources for development. This will have an impact on the tax structure and will change the culture of privilege towards greater equality and a better distribution. So I think that the headway made by Mexico is very, very important for the entire region. And it's also important to take a look at the tax resignation. This could become a privilege. In Mexico is a 4 GDP percentage points, and this is significant. So I believe that this fight against corruption, caring for public expenditure, strengthening the tax authorities' ability to control and inspect is very necessary for the Mexican fiscal situation. And Mexico is very credible in its level of investment and risk rating. It's very attractive for international investors. So I think that if required, I think that Mexico is one of the countries that does have this available to it. Well, thank you very much, Executive Secretary, and also thank you very much all our journalist colleagues who have accompanied us during this launch. And we would like to remind you that all of the materials associated to the economic survey of Latin America and the Caribbean are already available for you to download from the ECLAC website. And also the presentation just given by the Executive Secretary. And any other question that you may have in relation to this launch, the ECLAC Public Information Unit is at your service. Executive Secretary, I did want to ask you, in terms of the press conference and launch, would you like to share any final comment? Yes, thank you very much. Yes, once again, I would like to thank the team that has so actively helped launch the report, and also thank Daniel Titelman, Ramon, Cecilia, Michael, and Noel, everyone who has been diligently supporting the offices in Mexico, the Caribbean, and all ECLAC offices involved in the drafting of this study. And say that, well, I believe that the core messages are that this pandemic is going to be longer than expected. We will need to continue, countries will need to continue making the appropriate monetary and fiscal efforts. I believe that debt will increase and fiscal deficit, of course, then as well. So we will need to have a very strict income policy and also international cooperation with access special to having a better distribution of the liquidity and with access to concessional funds. That is our message. I believe it is very important to have a greater solidarity at international level, as the General Secretary said, and also greater solidarity means self-interest. So thank you all very much for taking part. I thank ECLAC for all the technical teams, and you, Guido, and your team from communications. Thank you very much, Executive Secretary. And once again, I would like to thank the dozens, hundreds, in fact, of journalists that have joined us through this WebEx, and also the ECLAC webpage and Twitter, where we've launched the conference live, and everyone have been sending in their questions and doubts. So a warm welcome to meet again soon, because ECLAC is in full production and it will be with you throughout the year in launching these special reports on the situation of the region in different fields, the COVID-19 pandemic. We still have ahead a very intense agenda for ECLAC in the next weeks and months. So I thank you for being here and helping us to communicating the data, the arguments, and the ECLAC proposal in relation to the moment that we're going through, and the Public Information Unit of ECLAC is at your service. So thank you to help contributing to knowledge about these topics. And so Alicia Bárcena Ibarra, Executive Secretary of the UN Economic Commission for Latin America and the Caribbean, we thank you for your time and your will and your readiness to answer the questions asked by the journalists of the region. Thank you very much, and goodbye.